Hey traders, Raghi here, and in this update we are going to talk about ETF alternatives to commodity futures contracts. Now, commodity futures contracts, ETF alternatives are really popular even amongst futures traders because if you want to take certain futures contracts like the NASDAQ overnight beyond day trading margin, beyond essentially the 4 to 4:15 window Eastern every day, you need the initial margin requirement, which does not give you the luxury of day trading margin. It's actually the full margin. So for example, I can day trade the NASDAQ futures for as little as $500, but I need almost 17,000 to take that same contract, quote unquote, overnight past the close. So certain ETFs come in really handy. Well, in the case of crude oil here, a lot of traders feel uncomfortable taking crude oil overnight. Geopolitics, cost, any number of things. So a lot of traders will prefer to take the USO ETF trade in lieu of the crude oil futures. Now, I think a lot of traders who want to stay in the equity and equity options universe also feel more comfortable with the ETF alternative. And when it comes to day trading, you have the choice of both. You can trade crude oil or you can go to the USO. So for folks wondering, why would I consider both? Let's think about less why and more when. And for me, that option to go with options is oftentimes a risk control type mindset. Let's talk about crude oil this morning. So crude oil had a pretty significant sell-off that led to a buying opportunity, both in the HPMR, hourly price movement range, the V-score, the standard deviation of the volume weighted average price, and our Darvis via the Darvis signal. But look at the speed, look at the sell-off of the candle and the break of the HPMR. So we know we're in a buy zone, but we know there's a lot more volatility, a lot more chaos accompanying the move. So for some traders, they may forego the trade altogether, but for others who can shift, who are fluent and fluid in the ETF alternative, we can take the USO setup. Now here's the thing. I'm not really concerned about the USO structure or frankly, the USO signals. I'm not really focused on that. I'm focused more on the crude oil futures signal. So I'm looking at CL, but I'm going to execute the idea in the USO because there is a way that I can control risk. So again, I know my support zone is here. I know my buy zone is here on the CL. If the USO lines up, great, but it's not necessary. So we go take a look at the USO, and we have the Friday expiration, which means we're not having to pay too much for time, depending on what day of the week we're taking this intraday, but we never have to go any further out than the Friday expiry. And as that market sold off, I'm going to look at an at the money or slightly in the money option. And that leads me to look at the 49s, which at the time were trading about or even below $1. So less than $100 to engage in this particular buy. So very risk controlled in terms of the cost. And remember, cost is part of the equation for risk. So again, what have we done so far? We saw an opportunity in crude oil futures. Crude oil futures could be cost prohibitive in terms of their margin. And because of the way the crude oil futures contract fired off the buy, set up the potential buy, because of the volatility, we went with a more risk-controlled way to take advantage of the idea via the USO ETF. And we take a look at the options for the coming Friday. Pretty simple, right? I mean, where the strategy comes into play are the indicators and the four-factor approach that I use: time, price, volatility, volume, and the overall environment that all of that is happening within. So the buy setup actually followed through very nicely. We end up climbing higher, control the risk. You know, a lot of underlying futures traders may not have been able to sit through that volatility, but sitting through it with the long USO call was far easier. And then that call starts to climb up, and we're able to take advantage of the move. I believe those calls were sitting at 95, maybe at worst about $1. And I believe right now, as we moved higher, these are sitting at about $1.30, $1.35. So that's the kind of move we're talking about. Low cost, scalability, good liquidity, and an alternative to the underlying futures contract, most especially in sort of a volatile, high velocity, risky type dip into our buy zone.